Years ago, I used to work at a financial firm where I saw many people who were caught up in the excitement of investing. They would follow the trends, chase hot stocks, and hope for the best. However, they often ended up losing money instead of making it. It wasn't until I came across The Intelligent Investor that I realized there was a smarter way to invest. I was amazed by the timeless wisdom contained in the book, and it changed my perspective on investing forever. Hello, and welcome to this video on The Intelligent Investor Summary, 6 Key Takeaways by Benjamin Graham. Investing can be a complex and intimidating subject, but it doesn't have to be. In this video, we'll go over the most important concepts from Benjamin Graham's book, The Intelligent Investor, and how they can help you become a smarter investor. Introduction to The Intelligent Investor by Benjamin Graham. The Intelligent Investor was first published in 1949, and it has since become a classic in the investing world. It's been hailed as one of the most important books ever written on investing, and for good reason. Graham's insights on value investing and risk management are still relevant today, more than 70 years later. Who is Benjamin Graham, and what is his background? Benjamin Graham was an American investor and economist who lived from 1894 to 1976. He's known as the father of value investing and is regarded as one of the most influential investors of all time. Graham's investment philosophy was based on finding undervalued stocks and investing in them for the long term. Why The Intelligent Investor is considered a classic in the investing world. The Intelligent Investor is considered a classic in the investing world because it lays out a clear and simple framework for investing. Graham believed that investing should be a rational, disciplined process, not a speculative one. He emphasized the importance of analyzing the fundamentals of a company, such as its earnings and assets, before making an investment. Graham's approach to investing is all about minimizing risk and maximizing return over the long term. Overview of the book's structure and contents. Before we dive into the key takeaways, let's take a quick look at the book's structure and contents. The Intelligent Investor is divided into 4 parts. Part 1 focuses on the principles of investing and the concept of value investing. Part 2 discusses the analysis of financial statements, while Part 3 delves into the concept of market fluctuations. Finally, Part 4 provides guidance on constructing an investment portfolio. Key takeaway: No one. The importance of value investing. The first key takeaway from The Intelligent Investor is the importance of value investing. Graham believed that the stock market was subject to irrational fluctuations that could create opportunities for value investors. He advocated for a disciplined approach to investing, where investors would only invest in companies with strong fundamentals that were undervalued by the market. Explanation of value investing and how it differs from other investing strategies. So, what exactly is value investing, and how does it differ from other investing strategies? Value investing involves analyzing the underlying fundamentals of a company, such as its earnings, assets, and liabilities, to determine its intrinsic value. If the current market price of the stock is significantly lower than its intrinsic value, the stock is considered undervalued and a good investment opportunity. Key takeaway? No. 2. The concept of margin of safety. The second key takeaway from The Intelligent Investor is the concept of margin of safety. Graham believed that successful investors should always aim to buy stocks at a discount to their intrinsic value, creating a margin of safety that provides a cushion against potential losses. Definition of margin of safety and how it helps investors avoid losses. Margin of safety refers to the difference between the market price of a stock and its intrinsic value. By buying stocks with a margin of safety, investors can protect themselves against market fluctuations and unexpected events that can cause stock prices to decline. The margin of safety is essentially a safety net that helps investors avoid losses and achieve better returns over the long term. Key takeaway. No. 3. The difference between investing and speculation. The third key takeaway from The Intelligent Investor is the difference between investing and speculation. Graham believed that investing was a rational process based on a careful analysis of a company's fundamentals, while speculation was driven by emotions and market trends. Explanation of investing versus speculation and why it's important to understand the difference. Investing involves analyzing a company's financial statements, understanding its business model and competitive advantages, and evaluating its management team. Investors look for stocks that are undervalued by the market and have the potential to generate strong returns over the long term. Speculation, on the other hand, is driven by emotions and market trends. Speculators buy and sell stocks based on short-term market movements and rumors, rather than a careful analysis of a company's fundamentals. Speculation can be risky, as it often involves buying stocks at inflated prices and selling them at a loss when the market turns. Key takeaway. No. 4. The role of emotions in investing. The fourth key takeaway from The Intelligent Investor is the role of emotions in investing. Graham believed that emotions such as fear, greed, and hope could lead investors to make irrational decisions and cause them to miss out on long-term gains. Common emotional pitfalls for investors and how to avoid them. Some common emotional pitfalls for investors include buying stocks based on tips from friends or family, following market trends without doing proper research, and selling stocks during market downturns out of fear of further losses. To avoid these emotional pitfalls, it's important to have a clear investment strategy and to stick to it, even during market fluctuations. Investors should also avoid making impulsive decisions based on emotions and instead focus on the underlying fundamentals of a company. Key takeaway. No. 5. The benefits of a long-term investing approach. The fifth key takeaway from The Intelligent Investor is the benefits of a long-term investing approach. Graham believed that successful investors should focus on building a diversified portfolio of undervalued stocks and hold on to them for the long term. Explanation of why a long-term approach is beneficial and examples of successful long-term investors. A long-term approach allows investors to take advantage of the power of compounding, which can lead to significant returns over time. It also helps investors avoid the emotional pitfalls of short-term investing, such as selling during market downturns. Examples of successful long-term investors include Warren Buffett, who has famously held onto stocks such as Coca-Cola and American Express for decades, and Peter Lynch, who achieved significant returns during his tenure as the manager of the Fidelity Magellan Fund by focusing on companies with strong fundamentals and long-term growth potential. Key takeaway. No. 6. The importance of doing your own research. The sixth key takeaway from The Intelligent Investor is the importance of doing your own research before making any investment decisions. Graham believed that investors should thoroughly analyze a company's financial statements, management team, competitive position, and other factors before investing in its stock. How to conduct research on potential investments and why it's crucial for success. To conduct research on potential investments, investors should start by reviewing the company's financial statements, including its income statement, balance sheet, and cash flow statement. They should also examine the company's management team, industry trends, and competitive position. By conducting their own research, investors can gain a deeper understanding of the companies they are investing in and make more informed decisions about whether to buy or sell their stocks. This can lead to greater success and better long-term returns. Explanation of the difference between active and passive investing. It's important to understand the difference between active and passive investing. Active investors try to beat the market by conducting research and making individual stock picks, while passive investors simply track the performance of a market index, such as the S&P 500. While both approaches have their advantages and disadvantages, Graham believed that a careful and disciplined active approach could lead to greater success in the long run. However, he also acknowledged that not everyone has the time or resources to conduct thorough research on individual stocks, and passive investing can be a good option for many investors. The pros and cons of each approach and how they relate to Graham's philosophy. While Graham was an advocate of active investing, he acknowledged that there are pros and cons to both active and passive investing. Active investing can lead to higher returns if investors are successful in picking the right stocks, but it requires more time, effort, and skill. Passive investing, on the other hand, is more straightforward and requires less time and effort, but it may not lead to as high returns as active investing. Graham believed that a careful and disciplined approach to investing was essential, regardless of whether an investor chose an active or passive approach. He also believed that investors should focus on long-term returns and avoid the temptation to speculate or make impulsive decisions based on short-term market movements. Analysis of some of Graham's most famous investment principles, such as the Mr. Market metaphor. One of Graham's most famous investment principles is the Mr. Market metaphor, which he used to describe the unpredictable nature of the stock market. According to Graham, Mr. Market is a person who offers to buy or sell stocks at different prices every day. Sometimes he is optimistic and offers high prices, while other times he is pessimistic and offers low prices. Graham used this metaphor to illustrate the importance of maintaining a rational and disciplined approach to investing, regardless of the market's ups and downs. He believed that investors should focus on the underlying value of the companies they are investing in, rather than being swayed by short-term market movements. Case studies of successful investors who have applied Graham's principles to their own investing strategies. Many successful investors have applied Graham's principles to their own investing strategies with great success. For example, Warren Buffett, one of the most successful investors of all time, was a student of Graham's and has credited him with shaping his own investing philosophy. Buffett's approach is based on the principles of value investing, margin of safety, and long-term thinking, which he learned from Graham. By carefully analyzing financial statements, focusing on the intrinsic value of companies, and avoiding emotional decisions, Buffett has achieved remarkable success in the stock market. How Graham's ideas have influenced modern investing practices. Graham's ideas have had a significant impact on modern investing practices. Many of the principles he espoused, such as value investing and long-term thinking, are still widely used today by investors and financial professionals. In addition, Graham's influence can be seen in the rise of passive investing, which is based on the idea that most investors cannot beat the market over the long term and should instead focus on low-cost index funds. In conclusion, The Intelligent Investor by Benjamin Graham is a timeless classic that has revolutionized the field of investing. By understanding Graham's principles and applying them to your own investment strategy, you can improve your chances of success and achieve your financial goals. If you found this video helpful, please like and subscribe to our channel for more content like this. We appreciate your support and look forward to sharing more valuable insights with you in the future. Thank you for watching.